Hi, I'm Mark with Best of Us Investors. I've been investing for over 40 years and I'd like to share some of my insight with you today. I'm not here to tell you what to invest in, but to provide you with some information that may help you become a better investor. Please hit the like button and also subscribe to the channel if you appreciate this content. Remember, this is for educational purposes only. It is not financial advice. Last week, Cathie Wood was on CNBC Halftime Report to defend the performance of her ARK funds over the past year. Now, I'm not a hater of Cathie Wood's. Cathie's ARK funds have received a lot of attention over the past couple of years for their stellar returns. Her funds consist of innovative and destructive companies that will allegedly shape the future of the new world. A majority of the companies within these funds are considered growth stocks. These stocks tend to have no earnings and rely on the promise of innovation to justify their lofty stock prices. The success of these funds, as far as price appreciation is concerned, correlate to a time of low inflation and cheap money. Cathie has a belief that if a company is innovative and disruptive, it will show price appreciation within a 5-year time frame. And she appears to have an army of true believers who faithfully follow her every move. Now, this is fine by me. People are free to invest their money in a way that fits their risk tolerance and investing time frame. For me, I don't know how you can put a time frame on innovation, especially after the huge losses their companies have provided us over the past 52 weeks. Remember, a loss of 50% in stock price will require a 100% gain just to break even. So why is 5 years the magical number? She admitted during the interview that all they focus on is innovation. There's more to a successful company than just being innovative or destructive. The biggest single issue I have is how are they going to transform innovation and disruptiveness into positive earnings and shareholder value? This is especially concerning due to the changing economic environment we currently are in. We have increased inflation, rising interest rates, tapering, and a balance sheet reduction. Historically, these actions have not been conducive to price appreciation of growth stocks. Companies are in business to make money and reward their shareholders. For me, a lot of these innovative and disruptive companies seem to be in business to enrich their founders, directors, and key employees with sweet stock options and stock-based compensation. As the interview went on, she stated several times that her stocks were way undervalued. This made me wonder, what does undervalued mean to Cathie Wood? I think it means she bases value on the stock price alone. The price of a stock is down, thus it's undervalued. This is not being undervalued from a fundamental perspective. Teladoc, for instance, her second largest holding in ARKK and a large holding in ARKG, is currently down 78% in stock price over the past 52 weeks. Does this make Teladoc undervalued? Or is it just trading at a price that the market values a company with no earnings at? Over the trailing 12 months, Teladoc has lost $5.75 in earnings per share and has no free cash flow. So how do we value a company that has no valuation support? Seeking Alpha even estimates that Teladoc won't show positive earnings over the next 3 years. Seems like it's going to take a lot more time than 5 years for any investor to see a profitable Teladoc. When asked if all of her innovative companies can ever return to the previous prices, Cathie said, absolutely, all these innovative stocks will come back to the prior level and beyond the high price. She is very confident. Me, not so much. How long will it take to get back to even from a 78% loss in price appreciation for those who might have bought at the all-time high? Cathie made one more statement that really got my attention. She said our tech stocks are not in a bubble. In fact, they are way undervalued. This market slump, that's what she calls it, has investors running to the past. For me, I guess this means boring companies that make money and return value to profitability to me, the shareholder, via buybacks and dividends. I mean, Google has a PE of 23 and Apple a PE of 27. Are these companies not innovative? So let's do a little comparison between the top 10 holdings in ARKK and in the SPY to see where the real value lies. So here's a chart comparing ARKK with the SPY, the S&P 500. And you can see that we're looking at the top 10 positions in each of the funds. Now there's 37 positions in the ARKK, and there's 506 positions in the SPY. So the number one position, as you can see in ARKK, is Tesla, followed by Teladoc, Roku, Zoom, Coinbase, Exact Sciences, Unity Software, Unipath, Intella, and Square. Okay, these represent 56% of the total funds in the ARKK. We go over to the SPY, we can see Apple, Microsoft, Amazon, Google, Tesla, Google again, Meta, NVIDIA, Berkshire B, and Johnson & Johnson. Now, these 10 stocks represent about 30% of the total in the fund. We looked at price appreciation over the last 52 weeks on each side. We looked at the PE, and we also looked at the estimated earnings per share, or earnings per share for the trailing 12 months. Several things we can look at here. The top 10, ARK represents 56% of the total fund, shows that it's very highly concentrated in 10 stocks. The top 10 in the SPY represent 29% of the total fund, so you can see it's more diversified. You can also see that stocks in the ARKK are really not undervalued, as Cathie Wood has said. You can see here with PE ratios of 174, 66, 34. There's the only one right here, which is Coinbase. It actually looks like it's a value stock. And then you have Square. The rest of here that are blank do not have PEs because they have no earnings. So the average PE in the ARKK is 76.19 over 5 stocks, and 5 stocks have no earnings. Only 2 stocks in the ARKK, 20%, had a positive price appreciation. Okay, you can see here, Tesla and Intel. Okay, over the past 52 weeks, compared with 80% positive price appreciation in the SPY. So you can see the price appreciation went up in every stock except Amazon and Meta. 100% of the top 10 stocks in the SPY have positive earnings, and several of these offer dividends. Only 50% of the ARKK have positive earnings, as you can see here. Over the past 52 weeks, the share price appreciation in the SPY is up 11.33%, while if you were an ARK investor over the last 52 weeks, you'd be down 57.54%. So after reviewing the spreadsheet, I realized there are many ways to value the stocks held within any fund. For this purpose of this exercise, I chose to focus on the price-to-earnings ratio. I know it's not fashionable anymore to use the PE ratio, and growth stocks in general have a higher PE than value stocks. That's the whole point of this video. I mean, just look at ARK's average PE for only 5 of the top 10 stocks in the fund. It's nearly twice that of the SPY, and 5 of the top stocks don't even have earnings. That brings me to the second indice, earnings per share over the trailing 12 months. If I'm an ARKK investor, I get the privilege of having Cathie Wood manage my fund, of which I pay her a management fee of 0.75%. And for this, the top 10 stocks have returned me a trailing 12-month earning per share of 0.65 cents. My alternative in this example is investing in a passively managed ETF such as the SPY. This returned me $37.23 in earnings per share over the trailing 12 months, with an expense ratio of only 0.094%. In addition, the SPY has a distribution yield of 1.27% over the trailing 12 months. Number 3, stock price performance over the past 52 weeks. I included this indice because, well, that's why we're investing, to grow our wealth over time. ARKK is full of growth stocks, and many of these companies have no earnings or free cash flow. As Josh Brown correctly pointed out during the Cathie Wood interview, was the fact that we're in an environment of higher interest rates and higher inflation. He mentioned that in the 1940s and 1970s, where inflation was high, value stocks outperformed growth stocks by over 10%. Markets have cycles, and as investors, we need to adjust accordingly. Cathie Wood said, "I can't predict the performance of my fund over the next quarter or year, but give me 5 years and I'll show you a return, because all these stocks will be back to prior levels and beyond." This makes me kind of laugh. She can't predict the next quarter results, but seems to have a crystal ball about where the market's going to look like, or where it's going and what it's going to look like in the next 5 years. I wish I had that kind of insight. The other thing that Cathie said over and over and over during the interview was, if we are right, yada, yada, yada. Okay. If she's so positive about the future of all her stocks, then why doesn't she use the terminology, when we are right? One last thing that I caught, when Cathie was asked about what she would say to an average investor who invested their hard-earned money into her fund and now find themselves significantly down in value, she had an interesting answer. She made it about herself. She said, well, I have half my money invested in these funds, so I'm down also. Well, the first thing I thought about was, if you're so confident in these funds, Why don't you have all your money invested in these funds? In addition, and more importantly, where's the other half of your money invested? Over my career, I've been involved in many negotiations, and I've learned it's best to listen for what is being said as opposed to what they are trying to tell you. Cathie said a lot to me during this interview. So what does this chart show me? It tells me at the present time I would not be investing in the ARKK Innovation Fund due to both fundamental and technical considerations. Many of the companies in the fund have no earnings, and those that do have too high of a valuation. I think these positions have more opportunity to go lower, especially in an environment of rising rates. However, I would also not be invested in the SPY at the present time. Although fundamentally, I like the companies within the fund, the technicals show current price is trading below the 200 SMA and the MACD, RSI, and money flow index are all declining. If these conditions were to improve, then I consider opening a position. As a fundamental investor, I use fundamental analysis to help me identify potential investments and technical analysis to understand when I should enter a position in those potential securities. I don't blindly buy investments and hope something happens to make them go up. Hope is not a strategy. In the end, I want everyone to be successful in growing their wealth. I encourage you to complete your due diligence on any investment product before you buy it and make the case for yourself as to why you want to own it before you hit the buy button. So remember, the number one rule in investing is don't lose money. The number two rule in investing is buy at the right price. And the number three rule is go back to rule number one. This is not financial advice, but just some thoughts from someone who's been in the market for a while. I hope this was helpful. Thanks for watching. Please hit the like button, leave some comments below, and we'll see you next time. Thanks for watching. I know your time is valuable.